So you were looking for some stable, high-yield income for your retirement. You found what looked like a perfect investment, maybe a pipeline company paying a really juicy 7% or 8%. But then tax season rolled around, and that simple investment you thought you had, well, it turned into a complex nightmare. Okay, let's dive into exactly how this tax trap works. You expected a pretty straightforward Form 1099 in the mail by the end of January, right? Just like with all your other dividend stocks. But instead, weeks, maybe even months later, this thick, complicated document shows up, a Schedule K-1. It's confusing, it's late, and it's about to make your tax season a whole lot more stressful. So let's start with that first big surprise, the timing. Why on earth does this form show up so late, and why does it look so different? Well, this is where the calendar just doesn't line up. You see, most 1099s have to be out the door by January 31st, but the partnerships that issue these K-1s, they get until March 15th. And frankly, because they're so complex, a lot of them file their own extensions, which means you might not get that form until it's right up against your April 15th filing deadline. And this isn't some rare thing that happens once in a while. As this quote points out, this delay is a common, really frustrating feature of these investments. It forces thousands of people to file extensions every single year just because they're waiting on one single tax form. And if you've already filed, you'll probably have to amend your return, which just costs you more time and more money. So why the different form and the different deadline? Well, it all comes down to a fundamental misunderstanding of what you actually bought. Turns out, you didn't buy a stock. You bought into a partnership. Think about a regular company, like Coca-Cola. You're a shareholder. The company pays its corporate taxes, and then it sends you a simple dividend. Easy. But with a master limited partnership, or MLP, you're not a shareholder at all. You are legally a partner in the business. And the key difference is right there. The MLP itself generally pays no corporate tax. That's because an MLP is what's called a pass-through entity. It doesn't pay taxes at the company level. Instead, it passes all of its financial results, the good, the bad, all of it, directly through to you, the partner. That K-1 form is the document that details your specific slice of the entire business's activity. You're basically being taxed as a business owner, not just as a passive investor. Now, here's one of the biggest hooks that gets people into MLPs. A huge chunk of the cash you get isn't taxed right away. But this tax-deferred income, well, it comes with a hidden and a very sharp hook. So when you get that quarterly payment, you might notice that only a small part of it, maybe 20%, is actually considered taxable income for the year. The other 80% is classified as return of capital. And that sounds amazing, right? You get cash in your pocket and your tax bill stays low. But you have to remember, tax-deferred is not the same as tax-free. And here is the catch, the thing you absolutely have to understand. The IRS looks at return of capital as the company just giving you your own investment money back. It's not a gift. Every single dollar of ROC you get reduces your original cost basis. That's the starting number for calculating your profit when you eventually sell. Let's just walk through a quick example. Say you buy a unit for $25. You get $2 in return of capital that year. Well, your basis for tax purposes just dropped to $23. After 5 years, your basis is all the way down to $15. You've been deferring those taxes, sure, but you've also been quietly building a much bigger taxable gain for later. And then you decide to sell. Boom. That's when the tax bomb goes off. All of that income you deferred over the years is recaptured. And here's the worst part. That recaptured money isn't taxed at the lower long-term capital gains rate you were probably expecting. It's taxed as ordinary income, which can be almost double the capital gains rate depending on your tax bracket. All right, I need you to listen really carefully to this next part, because this is perhaps the most dangerous trap of all, especially for retirees. A lot of people put MLPs in their IRA, thinking it's going to shield them from all these complex taxes. Unfortunately, it can make things so much worse. This is a really critical question. If you answered yes, you need to pay very, very close attention to what's coming next. This could save you from a huge and very unexpected tax bill. Seriously, if you have your K-1 nearby, go grab it right now. We're looking for one very specific spot, box 20. If you see the letter V in there, that is a major red flag. V stands for Unrelated Business Taxable Income. See, the IRS has this rule. An IRA is for passive investing, not for actively running a business. And since you are technically a partner in an operating business, like a pipeline company, The income it generates can get classified as unrelated business taxable income, or UBTI, and that means the tax shelter of your IRA might not even apply. The magic number here, or maybe the unmagic number, is $1,000. If your share of UBTI from all the MLPs inside your IRA adds up to more than $1,000 in a single year, your IRA, not you, the account itself, actually owes income tax. And this is the part that is just unbelievable to most people. You won't get a tax bill. Your brokerage firm, Fidelity, Schwab, whoever holds your IRA, is responsible for filing a special tax return for your account. It's called a 990T. They will then take cash directly out of your retirement account to pay the IRS. It's a silent tax, and you might only notice it when you see a mysterious drop in your IRA balance. Just when you thought it couldn't get more complicated, it does. There's one last trap we need to cover, and this one has to do with how the tax code treats your losses. You know how with regular stocks, if you lose money on one, you can use that loss to cancel out a gain you had from another stock? It's called tax loss harvesting. Well, you can't do that here. MLPs have special, much more restrictive rules. A loss in one MLP is basically trapped there. It's called this silo rule, and it's a perfect name for it. Any losses you have from an MLP get suspended. They can only be used to offset future income from that exact same MLP. They're stuck in that one silo. This means you could have huge paper losses in one MLP, but still owe a full tax bill on the income from another one. Okay, I know that was a lot of bad news, but understanding these traps is absolutely the first step to protecting yourself. So now let's talk about a clear, actionable plan to manage all this complexity. Here's your 4-step defensive plan. First, just go ahead and assume you'll need to file an extension. It's so much better than rushing or having to amend your return later. Second, if you own MLPs in an IRA, you need to immediately check every K1 for that Code V Inbox 20. Third, you must track your own cost basis. Keep a simple spreadsheet of every distribution that was a return of capital. And finally, look, this is not do-it-yourself territory. Please seriously consider working with a tax professional who has real experience with K1s. And all of this brings us to the final and most important question. That high yield was the hook, right? But it came with late forms, a future tax bomb, a hidden tax in your IRA, and losses you can't even use. So looking at your own retirement, you have to ask yourself, is that extra yield really worth all of this extra complexity and all of this risk?